Now we'll discuss about financing activities. You know, all cash transactions are categorized into three parts: operating activities, investing activities, and financing activities. And we are going to discuss about financing activities now. Actually, whenever there is change in the capital or borrowing of the company or firm through cash, they are called financing activities. For example, fresh capital is introduced in the firm. That's a financing activities. That's not a operating activities. That's not a investing activities. Or if there is change, any borrowing means the long-term loans. If the firm has taken any long-term loan from the bank and it has got cash and created loan, that's a financing activities. Or firm or company has repaid loan. Be careful, I'm talking about long-term loan. If the firm or company has paid any long-term loan, that will be financing activities. So in financing activities, two things will be involved: change in capital or change in borrowing. So how can we change the capital? There are two options: either fresh capital or drawings. Drawings as well as capital withdrawn, both are the same things. So if there is fresh capital, there will be inflow of cash under the category of financing activities. If there is drawings or capital withdrawn, there will be outflow of cash under the category of financing activities. If the company or firm has increased the loan, what it means? The company has taken loan from outside and it's a long-term loan. It means the firm or company must have got the cash. So there is inflow of cash due to financing activities. If the firm or company has repaid the long-term loans, it means the company has lost cash because it has repaid cash. So that will be outflow of cash due to financing activities. So let me remind you all types of activities. All the transactions can be of three types: operating activities, investing activities, or financing activities. In operating activities, purchases, sales, expenses paid, incomes received, these are the things, they fall in the category of operating activities. Or they are also sometimes called revenue generating activities. And then investing activities, if the company or firm purchases or sells any long-term asset or fixed asset, that will be investing activities. If company or firm has increased the capital or decreased the capital, and if the firm has increased the loans or decreased the loans, that will be financing activities. Let me explain you all the things through one example. Suppose on 1st April 2010, A started business with cash rupees 10,000. During the year, the purchases, cash purchases were rupees 5,000, sales 9,000, expenses paid 1,000, furniture 2,000, loan taken 3,000 rupees. And on 31st March 2011, prepare the cash flow statement for the year. And to prepare the cash flow statement, you must have opening balance sheet as well as closing balance sheet. So there was no opening balance sheet because he started the business. So for closing balance sheet, first of all, we'll have to prepare cash book, then prepare income statement, then prepare the balance sheet. So I'm going to start first of all the opening balance sheet. Capital 10,000 rupees in cash, 10,000 rupees because this was the first day of the business. So this should be the balance sheet. So cash transactions, cash book for the year ended 31st March 2011. Opening balance, I mean to say 2 balance BD 10,000, 2 sales 9,000, 2 loan 3,000 because this firm has taken loan rupees 3,000. So it means this firm has taken cash from the bank. And on credit side, purchases 5,000, expenses 1,000, furniture purchased 2,000 rupees, by balance CD 14,000 rupees. So total 22,000 rupees. Now income statement for the year ended 31st March 2011. Opening stock 0, purchases 5,000, expenses 1,000 rupees, net profit 3,000 rupees. Sales on credit side 9,000. Total on both sides 9,000 rupees. Now prepare the balance sheet. Capital. Now write down in the inner column capital 10,000 plus 3,000 because opening capital was 10,000 and the firm made profit of rupees 3,000. So in the outer column the closing capital is 13,000. Loan 3,000 because this firm has taken loan. So it's a liability, long-term liability, must be shown on the liability side. On asset side, cash 14,000. This is the closing balance of cash book. And furniture 2,000 because during the year this firm purchased furniture of rupees 2,000. So total on both sides 16,000. Now we have to prepare the cash flow statement. You know, cash flow statement can be prepared. There are different formats, but I'm going to adopt the easiest one, that is T-shape, just like cash book. On left hand side inflows and on right hand side outflows. So on inflow side, opening cash 10,000 rupees, cash from operation 3,000 rupees. Basically, I'm going to write down the figure of net profit. You know, all transactions are cash transaction. If there is any profit and all transactions are cash transactions and there is no closing stock, net profit and cash from operation is always same. I have already explained you in my previous question why it's happening. So total 16,000. Now on outflows, furniture purchase 2,000, closing cash 14,000, total 16,000. So you must have noticed that in cash flow statement, all operating activities, they come in one box and that box is called cash from operation. I want to say operating activities are not shown individually in the cash flow statement, but other transactions, the transactions belong to investing activities and financing activities. They are shown individually in the cash flow statement. So this firm had taken loan of rupees 3,000. This was financing activities and this was the generation of cash through loan. So we have shown in the column of inflow, and during this year the firm purchased furniture of rupees 2,000. Whenever any asset is purchased or sold, I mean to say fixed assets or long-term assets, it's a investing activities, they are shown individually. So this is the cash flow statement.